My dissertation was the political economy of special economic zones.
Okay.
So this is just special economic zones itself is very much in the area of international trade, economic development. And then the political economy part of that is understanding like the political economy context in which they're created and when they work and things like that.
Okay. And so did that directly tie into what you were doing at William Blair or not really?
There were some connections, but there was actually a tremendous amount of overlap between the broader coursework and what I learned at George Mason that I then applied at my work at William Blair. I did the monetary policy, which I had taken with Professor Larry White at George Mason. A lot of the macro stuff I used and the political economy things as well. We did a lot of like political analysis. We did macro investments. So we were invested on a country basis, equity markets, currencies, and bonds, mostly sovereign bonds. So naturally, this perspective of the political perspective, the economic development perspective becomes very important. So I did a lot of like valuation model work and things like that. The special economic zones thing, it came in sometimes because it's like there are a lot of emerging markets that we would be looking in that people might be excited about them having a special economic zone program, and I can look at it and pretty easily get a sense of whether that is going to be a driver of the economy. And I was invited to do some talk in the industry because of people being interested in the topic. But it wasn't like the biggest part, I would say. A lot of it was just the broader economic education and training that I have from George Mason.
Right, and correct me if I'm wrong, but so the person, like your direct boss there that you interviewed with, Brian Singer, he also was a fan of the Austrian school, right? Because like you guys had like a reading. I think that was like partly how I got to know you guys. Is like I would Skype in for some of your book club or something, right?
Yes. Thank you so much for doing that. Yeah. So I have been on a perennial quest in the US of finding good people. And the way I'm doing that is just starting things. I start a book club we recently, and this is a big plug here, started the Bastiat Society of Fort Lauderdale. We are having our second speaker coming up in about 3 weeks. So that's exciting. The head of Free to Choose Network, the CEO there, Rob Chatfield, speaking last one. And in Chicago, yes, we had a meetup. We had the Austrian Economics and Libertarian meetup. And I'm sure we invited you to that, but that was more like meetup means it's open. So you meet somewhere and people come. We have a book club that was very much with the people that we have found through friends that were this core group of really good and smart people where we would read like bigger books. Like we would call it first a TMS group because we read Theory of Moral Sentiments by Adam Smith first, but then it kind of became just the book club, free market book club.
Right. Okay. So I guess for the listeners who are, in the financial sector in various capacities, an obvious question that I would get a lot is, did that give you guys an edge? Like, I mean, so Brian having that, that element of his worldview and then, bringing you on, like, was there a thing where you thought, yes, our team, we're going to have better returns than some rival team that's just as competent, but they haven't had this exposure to the, free market economic perspective?
Yeah, I definitely think so. Like you see, there's so much when it comes to macro, there'll be a narrative around some development. And people latch on to certain narratives that if you don't have the political economy kind of perspective, you won't analyze it in the right way. And narratives that are when you apply any economics to it. I mean, there's a lot in the finance journalism. Okay, great. You got an undergrad in economics where you picked up the basic Keynesian stuff. And you see that everywhere and people believe it. It's like this whole inflation drives growth or stuff like that. And you actually see that when you look in the numbers and there's a new inflation number reported and people get kind of optimistic about it, or just analysis when you do evaluation, people assume that have different assumptions of what drives growth, right? I mean, we introduced a really core part of our valuation work was looking at economic freedom in the world. So you have the Fraser Institute having the Economic Freedom Index, and applying that and seeing, okay, where is this country going? Can we assume that? And there's some good literature. There's some good scholars having written papers whose names I won't remember now, but looking at both the trends, and does it tend to be a mean reversion? If it's really high, maybe we'll go lower. All those kind of things to try to project what could be those kind of drivers of ultimately productivity. I mean, you can think of it a little bit in that neoclassical framework, like the Solo model, right? You have like the capital, you have the people, and then you have this productivity part. And the productivity is, of course, what drives the whole dynamics of the model as opposed to an static equilibrium. And that's very much, I think, on its basis, I think it's the right way to think about it and not be too fooled by hearing that capital is flowing in somewhere. Well, do you have the institutional foundation to sustain that or not? So a lot of perspectives like that I could go into. That I do think that we had a very different analysis. I would meet with, sometimes there'll be analysts who are trying to sell you a product or something like that, and their chief economist is there. So many people, you won't believe how many people actually fall for, say, the broken window fallacy. So they'll be like, oh, well, it's great that they have an earthquake now because GDP is going to be higher because they have to rebuild the whole cities. Right. And it's just like, what are you talking about? Like, it's true that it's going to be, but we all know how artificial and short term those kind of numbers are.
Yeah, and just for the benefit of the viewers who haven't heard that, so it goes back to Bastiat. You mentioned the Bastiat Society, but yeah, that was one of the classic things he wrote about. It's called the broken window fallacy, where the story goes, there's some hooligan kids and they throw a rock or something and it breaks I forget what he is, a baker or something, his window, his storefront. And so he's mad and everyone's mad. But then some wise man from the crowd says, well, no, if you think about it, it's a good thing that those kids broke that window, because now it'll give employment and income to the glazier who has to fix the glass. And then he'll go spend it down with the cobbler when he buys new shoes. And so it's like these kids somehow not magically, but raise the income of everybody in the community. And it's a good, and of course the fallacy is the money that was spent on that could have been spent on something else. So the employment would have been the same. It's just, you wouldn't have been started out down a window. Like, better to have all those people working and creating new wealth rather than just replacing the thing that was destroyed. So, likewise here, if there's a hurricane or an earthquake, yeah, you can go, that quote creates employment in those sectors to fix that stuff. But the workers, with flexible wages and prices, those workers would have been doing something else and adding to the net wealth of the country rather than just replacing what nature destroyed. So
exactly. No, thanks for that clarification. No, but yeah. And also like other, models in undergrad where you have GDP equals consumption and investment in government spending. So you get government programs, and you actually hear like the analysts saying, well, government spending is going to go up and that's going to be good for the economy, and therefore you should like invest in this country. And they can bring out that because Keynes said, right, it's a mathematical fact. If you're educated, you know this. So yeah, things like that you don't have to fall for if you have some a little bit more deeper and specifically, certainly free market Austrian education.
Yeah, and even some of the real technical stuff, I know this was actually a lot of, I don't know how much I relate to you guys, but when I was talking to you and Brian there, when I was actually trying to figure out, because folks, I spent some time in Chicago at this period where, when they were there too still, so it was overlapping, and I was trying to see if there was something like, I was basically trying to get Brian to give me money to do something on the side, and then it just didn't work out. But what I wanted to do was, like when I was at NYU and I noticed, like even like in the hardcore finance literature, they would have these models that involved interest rates, and they just assumed like, it follows a stochastic, process, and it's a random walk with this drift, and like they had no theory as to what makes interest rates do what they do. And I thought, well, surely that you could have some predictive power if you knew something about why interest rates move the way they do and didn't just view it as this like black box. So anyway, there's lots of really smart people in the financial sector that are really good at this narrow thing. But yeah, when they start talking about bigger causality, like you just know, that's not right. And surely, at least in some settings, the fact that they don't know what drives big trends, that would presumably lead them to make bad investment decisions.
Right. I mean, interest rate, it is a more technical discussion, but I think that has been a very intriguing topic, and we've talked about it. I would say that both from economists and then financial people, you get different kind of what I would see as the common fallacies that I come across. And I would say on the economic side, it's very much this neoclassical view. And I would say that it took me a long time to figure out kind of why often doesn't really make sense. So the neoclassical view is basically like savings and investments and it's supply and demand, and here's the interest rate. And that's kind of how you learn in undergrad. There is really no research that I found to substantiate that. And when you start looking at kind of the movements of interest rate that we had, it has been the central bank pressing interest rates down. And any data that people use often start in the 80s. So you basically have like Greenspan coming in and starting this kind of trend of, hey, why don't you always get the real rate as low as possible? And that has kind of been the aim for a long time. And yeah, so I mean, who would believe that interest rates being high now are because of supply and demand of money? Like we know what happened. They printed a lot of money because of COVID, because they shut down the economy. They, as in the central bank, printed the government after the governments shut down the economy. So that I think is more battling like the neoclassical perspective that I would disagree with. And you can find some research going back a few decades, and you can fit like a demographic dividend kind of curve or dependency ratio curve pretty well over a certain period of interest rates going up, like real rates, and then going down. But one definition of real rates is not that easy, because if your rates is a forward-looking concept and inflation is a backward-looking concept, so you have to assume that people have perfect foresight about inflation for you to say like this is the rate that they felt was right at the time. And then on the finance side, I would say there are different views that you can say interest rate. Like you can stack it up as like some kind of the risk-free rate and then the risk premium, for example. And that's usually how people think of it. But the other way of thinking about it is from the demand side, so to speak, which is similar to the economics perspective, which is there is the time preference. You have a time preference, and then on top of that, you have some kind of risk premium. And then if it's whatever else is your cash flow, it might be an illiquidity premium or default premium if it's a bond and things like that. And there, the big question also becomes like, what is this thing about the time preference? There is this assumption that you always want more now, and then people are myopic and things like that. And I haven't really seen that. So I'm still like on the camp of disputing that is actually like a real thing, because the other aspect of that is research showing how suboptimally small consumptions are for people like who are students, for example. Like if you're in a PhD program like me, I was definitely falling for this fallacy, if you'd say it's behavioral flaw, whatever you would call it, which is you spend too little in terms of like you find the cheapest little place, a little room, even though you're in a PhD program. Like if you look at the probabilities of your lifetime earnings, you're probably gonna do okay. It's okay. Like you can have an apartment. So I've come across this a lot, like in wealth management, for example, in finance. It's a lot of this. When you're advising a client, you have to either adhere to or stem their proclivity to always want to spend today rather than tomorrow. When in fact, a lot of people are actually way too frugal for their own good, if you would see it in some kind of objective sense. I mean, you can always put in your moral hat and more own perspective on it.